Investor, the hottest investment show in the world. That's right, I said it. I don't care who knows it. Remember, whenever you're introduced to any type of investment opportunity, you always want to ask 4 questions to start. Number 1, what is the return on investment? 2, when do you get that return along with the money that you put in? 3, what is the minimum investment amount needed? And 4, what is the risk, the worst case scenario? This whole show, Everyday Investor, is designed to help us grow our money. We all use our precious time to go to work, to make money in order to provide. So we take our time, we go to work, we make money in order to live. Imagine a life where money could make you money so you could work a little less, have more time for the things that mattered most. Family, friends, a purpose greater than yourself. Super excited about this show. We're going to be talking to Mel Dupuis. We're going to be learning how to make money investing in a 6-unit building. You don't want to go anywhere. Everyday Investor continues in a moment. Hey, it's Rav. Welcome back to Everyday Investor. Today we're talking to Mel and we're learning how we can make money investing in a 6-unit building. Mel, thank you so much for doing the show with me.
Thanks so much, Rav. Great.
And yes, and for the people that recognize this familiar face because you are teaching real estate investing all over social media and all over the platforms, they're going to say, "Hey, where's Big Dave?" It's the Mel and Dave team. I'm just kidding. We have 20 minutes or so to do this, and I look forward to having Dave on a different show. But tell me a little bit about how you and Dave got started investing in real estate, because, I mean, you know, correct me if I'm wrong, but you have close to 200 tenants that you take care of, but also help you feed your family and perhaps have some guests over from time to time. How did you and Dave get started in this?
Yes, absolutely. Thank you. So I had 2 properties when I met Dave. Dave had the one, and we both had a passion for real estate. We knew that it was going to be our key to success and financial freedom. So we slowly started buying properties the traditional way. And then around building number 5, we hit a common roadblock. We ran out of money. We couldn't come up with that 20% down. And then we discovered the power of creative financing. And that's when we exploded our growth. We're well known to have purchased 12 properties in 12 months using none of our own money and no joint ventures. And yes, you're correct. Now we solely own over 170 units, close to 200 next month. Now, the reason we're now on all over social media, we never used to be. In fact, we used to be very secretive on how we grew our portfolio. And that was until 2018. I'll remember the day forever. We're on our way to a real estate investing conference, and our vehicle got struck by a careless transport driver that hit us. We rolled 4 times across the highway, landed upside down. And it was a day that changed. And I have 3 kids, so you can imagine during that time what I'm going through. And it was a day that changed my life for so many reasons. And one of them, I realized that I just couldn't go back to work. I didn't want to do that one more day of my life. And because I already had a portfolio, I had the freedom of choice to do so. So I quit my full-time job and never went back. And that weekend, also the weekend, I realized, why are we not helping other people achieve financial freedom through real estate investing? And that's when we started being online and being everywhere and helping others create their own freedom, because again, there's nothing special about Dave and I. Anybody can do this with the right tools and strategies.
Well, thank you for being vulnerable and sharing that. You know, it often takes something like that for us many times in life to be able to, you know, just be grounded and declutter and really say to ourselves what matters most in our life, you know? And yeah, with 3 little ones at home, I can't imagine. And so I'm glad the both of you are okay. And thank you for nurturing people in how to grow the money that God's given them. I mean, it's a great thing. We don't all want to be 65, 70 years old and enjoying by ourselves. We want to be able to enjoy with family and friends, because that's what life is all about. So 170 units, and you said next month 200, tenants, and then next month you said 200. So I don't want people to get confused with them thinking that you're going to buy 30 buildings next month. You actually buy buildings, in this case, a smaller one, perhaps a 6-plex, and then that's how you accumulate the tenants. Do you still do single family homes, or is mostly all of your investments multifamily?
Yes, and to clarify, when I say units, I mean number of apartments.
Yeah.
It's going to be about 30 buildings, so apartment buildings, and we vary. I mean, typically we have one single dwelling home. We sold one of them. Our specialty is multifamily. That's our preference, and we'll go from anyone. I mean, our biggest one's a 50plex, but we have a duplex and one single dwelling as well. So just at the end of the day, it's all numbers. One makes sense.
And Mel, what is there any wisdom in starting with a single or a duplex, or with the right education, can you jump right into the 6, 7, 10, 20 units for the one or two furnaces, if you will? What's your mindset there? Because, a lot of people say, yeah, but I need to graduate into that. What's your mindset on that? Do you need to graduate into it, or can you jump right into a 10plex if you're educated?
Now that I know what I know, I wish I would have jumped bigger sooner, but I certainly lacked the confidence of the education when I first started off. So no, if you with the right strategies, right education, real estate strategies are strategies. Don't set yourself that roadblock that so many of us, when we start off, we think 2 units, that's our max, or 3 units, that's our max. Again, as long as you have the right tools and strategies and training and knowledge, then there's no reason why you can't go bigger if that's what you want to go after.
And it's many people who invest in multiplexes like yourself. First of all, define them in Ontario. What is a multiplex?
Yes, so multifamily is one building where there's more than one apartment in it. So whether it's 2 apartments in the one building or 40 apartments in the building, that's considered multifamily. And as part of that branch, sometimes there might be a couple commercial units as part of that, but overall I prefer multifamily because people will always need a place to live.
And where I was going with it is, a lot of people that invest in multifamily, they say it's actually easier when you are 5 units and above, or 6 units and above. Which one is it, 5 or 6?
5 and over, yes.
5 and over, because then the bank looks at this building as a business, as opposed to them looking at Rav, and Rav didn't pay his latest car payment, so therefore they're not giving me a mortgage. Is it true? Is it easier in many ways to go 5 units or more, or is it easier to do the 1 or 2?
Again, it's going to vary from one person to the next. If you don't have high income and you really, really need those ratios, then yes, maybe going 5 up might help you for sure. If you already have a good income, then it won't really make a difference for you. So it just depends where you are. But having the ratios, and something I didn't realize when I started off, that it's also not just about you as the owner or as a buyer. You have to make sure that the numbers and the ratios of the actual properties make sense. Because I remember having my first no, and I thought, what? I have good credit. I thought things made sense, but it was the property that wasn't approved. It had nothing to do with my own finances. It's also the property itself as well. But yes, you're right. 5 and over, they do calculate part of the income as well.
And yeah, I mean, we play a game of Monopoly. We still have to follow the rules wherever you are, and the rules happen to be that whatever they are in different times, the bank says this, the bank says that. When I was talking to the producers, Nicole in particular, I thought, oh, so Dave and Mel, they do, because they have so many and they've run out of money, like we all do when we're investing. So they partner, they do, joint partner relationships. And Nikki was saying, no, not necessarily the case. They don't joint partner so much as so they use the sellers, the vendors' money, like in this case. Tell me a little bit about that philosophy. Is that across the board? Is that what you try to do, as opposed to, letting little old passive investor Rav get in on your deals? Kind of what does Dave and Mel, what's ideal for them? And don't worry, you wouldn't hurt my feelings.
Yes, and I was just going to say that. Now, there's no right or wrong. This is just the way that Dave and I did it. Now, Dave and I, we chose not to go the joint venture route. So instead, what we do, we use other lenders, so outsourced lenders, so they're not attached to the mortgage. We don't split the equity. I get to keep all the profit, all the appreciation. So things like different strategies, such as owner financing. That's also known as VTB, vendor take back, or seller financing. There's different names you may hear out there, but they're all the same strategies. properties, and also different things such as somebody's RSPs, for example, or through a promissory note. So we essentially don't use our own money. We use other people's money to help fund. Typically, it's the deposit piece, the 20 or 25% down that we'll need.
Okay, so I can get involved. It's just not on a equity basis where we're doing a 50-50 split. But if I wanted to, if Dave and Mel needed the down payment and some money for closing costs, maybe even renovations, I could lend you that money and we figure it out, whether it's 12 months or 24 months or 18 months. What's the range in return on that? If I were to lend you, let's say for 12 months.
Yeah, and honestly, it's going to depend of the deal, and it depends of how it's also lended. I mean, if it's owner financing, usually the interest rate I have to pay is not quite as high because it benefits them as an owner. They can defer their capital gains. If it's a promissory note and it's not secured to the mortgage, then in that case it would be higher. So it just depends of the term. If it's RSPs and I'm doing a 5-year, so it kind of, if that means I'd have to pay lawyer fees. So it just depends of every deal is really different. And I always think bigger picture. I'm always okay to pay more interest than I typically would because that means I get to keep 100% of the cash flow, 100% of the appreciation, and 100% of the equity. And as long as the deal can sustain it and I'm still cash flowing and I have that huge potential appreciation as well, that forced appreciation that we love going after, then it's a win-win for me and for everybody that do deals with us.
That's great, Mel. I hear you saying it's all about the numbers always, and don't be afraid, for the investment amount. It takes money to make money. Thanks for being here again. Let's take a quick break and let's break down the numbers on this sixplex. Thanks for watching, everyone. Everyday Investor continues in a moment. Hey, it's Rav. Welcome back to Everyday Investor. We've been talking to Mel and we're learning how to make money investing in multi-family apartment buildings. In this case, we're looking at one of their smaller properties, a 6-unit building. Again, Mel, thanks for being on the show and really just teaching us how you and Dave invest and why you invest. It's really to enjoy your family and friends, and I can't thank you enough for doing this. I know you guys are very busy. So we're going to look at a 6-unit building. This was purchased where?
This was purchased in our city. So we're in North Bay, Ontario, about 3 hours north of Toronto, 4 hours of Ottawa. And it was in our city. Okay.
Now, would you always, what's your thought about investing in your own backyard? Obviously, if the numbers work, then it's amazing. But let's say North Bay didn't have the greatest, places to invest, but yet your family's there, your kids are in school there. What would you do? Would you invest outside where the numbers were good?
And I would base it on, what do I need? Do I need a huge appreciation? Do I really need a lot of cash flow as well? When I started off, I knew I wanted to quit my full-time job. So cash flow was really important to me. So yes, in that case, for sure, I would have been in a market where I can get that extra cash flow to get closer to achieving my why. In our market, it's kind of a perfect storm. Low vacancy, high cap rates, good cash flow, high rent. So it's a perfect storm. So that's why it just made sense to go for this property.
Yeah, and you can, as long as you have the systems in place, there's nothing wrong with investing somewhere else and taking care of things remotely. I mean, right now I'm in the GTA, I'm in Brampton, you're in North Bay, and we're doing a TV show. So yeah, in 2020, 2021, regardless of what COVID says, you can still make things happen. You have to pivot. So we're in North Bay, and what was the purchase price of this?
So this one was a 6-pack. So we purchased it for $575,000.
So $575. Okay. So then, how do we make money on this? There's a down payment.
So the down payment that I typically would have to come up with, because it's commercial, so it'd be 25% down. So usually it'd be $144,000. But I don't like using any of my own money. So I asked, in this case, Mrs. Seller, if she would be open to doing owner financing. And what essentially that means is that she holds that portion of the mortgage on my behalf. And the reason people want to do this is because it benefits them. They're not just doing it to be nice. Of course, it makes sense for them as well. They can make a little bit of interest every month. And mostly they get to defer their capital gains, which that was important to her. It also meant that she got a quick closing day. We took it over. She didn't have to worry about doing viewings or anything like that. So that's why she agreed to do 25% BTB or owner finance.
And I'm guessing, Mel, that she didn't offer this to you. You had to approach her and explain, that this even exists.
Absolutely. Yeah. I've approached a lot of people throughout the years. It doesn't work for everyone. You're going to get some no's if you try this strategy, but certainly we've done many, many deals this way.
Okay, so it's commercial. The bank wants to see 25% down. You borrowed that money from the seller.
Yes.
The rest of the 75% you got from the bank. So when I say what was your down payment, there's some interest, but we'll work that in later. Really, you're saying zero. Is that what you're saying?
Exactly. Yes. Yeah.
Wow.
Because the interest, essentially, I deduct that from my cash flow. So it's
Okay.
calculated as part of that. Yes.
Okay.
Yeah.
Very, very clever. I love that. I love that you did that. Okay, so then what about closing costs? Did she pay for that as well or no?
No. So sometimes we're able to, but in this case, no. So this one was around $10,000.
Okay, so 10K you did in closing. And then did we do anything to this property? I mean, usually when you buy, I'm sure you add value to units and you're kind of looking for underperforming properties. And then you can increase the value by putting, whether it's lipstick or even more onto it. Did you do that in this one or no?
Yes, I did some. Now, this one was interesting. The rents were very, very low, like hundreds below market. So as soon as we saw the numbers, we knew there'd be a huge lift as soon as there'd be tenant changeover. But there was also one unit that was completely had to be redone. So we did that one, and it wasn't fire retrofitted. So we had to get a fire retrofit. We had a pretty good idea how much it was going to cost us as well. So it wasn't anything too much. So we spent $30,000 between the both.
30,000 on top of the 10?
On top of the 10, yes.
Okay, so you're 40,000 then.
Yes, for my
10 for closing and 30 for rentals.
correct.
Okay, any other costs?
No.
Okay, so you're into this property out of pocket for $40,000, and knowing you, it probably wasn't out of pocket. Maybe a credit line or again another lender, but let's just leave it at $40,000 to buy a property that's 575. So really, you're kind of just whatever that is, 15% perhaps. No, I don't even know what that is. What am I talking about? So that's all you're in for is $40,000 to buy this property.
Correct.
Okay, so now teach me how we make money.
Yes. It's all about the money. So this one, it was the rents were low, so we knew increasing the rents as the tenants came. So the cash flow yearly was so with the new rents is $43,000.
What? $43,000?
Yes.
So that's over $3,500 a month.
Was that yes, $3,500 in cash flow.
Yes.
And that's after we had refinanced it as well. Now this one, for example, it has the majority of them are 3-unit bedrooms, huge bedrooms. So we knew, but they were renting, I think, for $1,000 or $1,100 when we started off, and now they're renting $1,500, $1,600. So it just had a huge potential in those rents alone because it has everything you need. It's perfect location, parking, bedrooms, large bedrooms, everything they need. So it's a great property.
So you did your renos, then you went back to the bank, you refinanced, and your cash flow is $43,000 per year.
Correct.
Cash flow.
Cash flow.
Wow, that's close to the average Canadian salary. I think it's around $50,000 a year on one sixplex. You're cash flowing this much. I think I need you to define for us what cash flow means.
Yeah, so cash flow is after all of my expenses. So that includes after paying my hydro, my gas, my taxes, the mortgage as well. Of course, we repaid Mrs. With the refinance that we did, we repaid Mrs. Owner Financed. it was a higher amount refinance, but it was a much lower interest rate. So the numbers, and we knew that, of course, because we've pre-crunched the numbers to make sure. And that's why, so yeah, so it's basically all your expenses, what is left for Melanie at the end of the day in my pocket. Now I have to say, and I know, out of this deal, how many deals did I look at? We look at numbers, we look at deals all day, every day. And I think that's very important, right? So is this the first property that I crunch numbers on? No, we crunch numbers every single day. We're very aggressive with our marketing as well. So we have deals all the time, but that's how we're able to find these underperforming cash flowing properties.
And I think Dave and Mel are gonna have a problem on their hands, because I think there's gonna be a lot of Ravs that are gonna say, hey, please joint venture partner with me, because I wanna enjoy at least half of this $43,000. Okay, so how else are we making money? The great part of real estate is we have tenants paying down our mortgage.
Yes.
Correct? So what is the, I'll call it the mortgage pay down?
Yes, and now it's not quite as high because of my calculations. I pay a bit higher interest, so this is not quite as high as some of you might have seen. So it's $13,300
for the year.
Yeah, yearly. Yeah.
Okay, and so that's how much they're paying down in the beginning, but over time, obviously it'll be bigger.
Yes, exactly. And again, once VTB now has been paid back, the refinance, so I can bring it back to a NA lender, because usually the banks won't approve these kind of creative financing deals. So you do pay, again, a little bit higher interest, but again, it's looking at the full picture. And that's where I find a lot of investors get stuck, especially as beginners, is that they only look at the interest. Oh, well, I don't want to have to pay this much, yeah, but if that means that you're able to continue to grow and not use your own money, as long as it makes sense and you have your exit strategy to pay them back, it's a win.
It's all just about the number. So this obviously is what they're paying down. And then of course it naturally will go up. It'll appreciate naturally, right? What number do you use for natural appreciation?
So I use 2% in this case. Again, we don't live in a hot market, so I'm being very conservative. Interestingly enough, right now, where I was just speaking with somebody and he said on some properties right now it's 10%, but that's not typical here. So I use 2%. Just again, I always want to be conservative. So that would be 11,500.
11,500. Now we could stop here, but you put in $30,000, and so that $30,000, the value of 575 is no longer 575. You've increased the rents. When you take that rent and you divide it by whatever the capitalization rate is, it just will obviously bring up the value. Did you get an appraisal?
We did. We got it reappraised, and we got it reappraised at 2.5 years later.
Yeah.
And it got appraised at $840,000.
$840,000. So what's the difference between the 840 and the 575?
$266,000.
266, and that was in 2.5 years.
In 2.5 years, correct.
Okay, so that's not bad. That'll take you to Turks and Caicos for a week or two. I think that amount of money, that's amazing. And so do me a favor, you got your calculator there, because if I add that into this, it's going to be 1,010%. So why don't we do me a favor? Let's add up 43,000, 13,300, and 11,500.
So that's 67,800.
67,800. So I'm going to call it 68K. Okay, so you make, because this is all in the first year. Right?
That's all the first year.
So you made 68, and divide that by 40 for me. 68,000 divided by 40,000. Move that decimal place a couple over.
170%.
So that's 170% that Mel and Dave made in their first year, and I'm not counting the forced appreciation of $266,000, folks. This is wonderful. Time has run out, Mel. Thank you so much for teaching us this.
Oh, thank you so much for having me.
And thank you for watching at home, for listening via a podcast. So grateful that you would do that. If it wasn't for you, we wouldn't have a show. Make sure you tune in next week, same place, same time. Honey, I love you. I'll be home soon. Thanks for watching, everyone.